Car finance comes in several varieties. It is important to understand the features of each and whether they would be suitable for you before looking at quotes. There are two main types of car finance: hire purchase and personal contract purchase. Remember, there are other sources of finance also, such as personal loans, which are detailed in the sources of finance video. What all car finance has in common is that the loan is secured on your car, meaning that you do not own the car until you've repaid the finance in full. You cannot sell or modify the car without the lender's permission. The lender can repossess your car to put towards your repayments if you fail to make repayments when due. This is an automatic right until you've made 1/3 of the total repayments, and after that point the lender can only repossess your car with a court order. Personal contract purchase, or PCP, has two key features. Part of the loan amount is deferred to the end of the loan term, something called the guaranteed minimum future value. And this means your monthly repayments are smaller as you do not pay off the full cost of the car during the term of the loan. At the end of the loan, you can either return your car and walk away with nothing further to pay, or if it's worth more than the balancing loan payment, you can sell or part exchange it and keep any amount in excess of the finance settlement. However, you also need to be aware of some of the restrictions with PCP. You must decide up front a maximum annual mileage, and if you exceed this, you may be charged. You must return the car in good condition with the servicing and maintenance completed when due, and again, you can be charged if this is not the case. PCP is only available on new or nearly new cars. Typically, the car must be less than 3 years old. The total cost of borrowing is greater than for hire purchase, since you're paying interest on a higher balance, and therefore if you want to own the car outright, hire purchase would usually be cheaper. At the end of the loan, you are likely to require finance in order to afford another car, and unlikely to have much deposit available from the part exchange of your car, since most or all of that part exchange value will go to the lender to pay off your loan. So let's look at an example. For PCP, you decide the length of the loan and the number of miles per year. The lender then calculates the future car value and the monthly payments, which are based on the car value, the amount borrowed, your income, credit rating and personal circumstances. At the end of the loan term, you have the option to buy the car, part exchange the car, or return the car. You must ensure you keep to the conditions agreed to avoid being charged. PCP may be suitable for those who need low repayment amounts, who plan to replace their car every 2 to 4 years with new or nearly new cars. If you do not wish to own the vehicle outright, if you plan to continue purchasing cars using finance, or if you're expecting a significant future income that you would put towards repaying the loan balance, and if you want protection against unexpectedly severe depreciation. Next, we look at hire purchase. The key features are that the finance is repaid in full over an agreed term of the loan. And this means that the monthly repayments are higher than PCP, since you're paying back the loan in full rather than leaving a balance to the end of the loan term. At the end of the loan term, the car is yours, and you can either keep it or sell it to put towards another car, and any sale amount is yours in full, which differs from PCP, where most or all would be used to pay off the remaining finance. The total interest cost is cheaper than PCP, since you're paying down the loan quicker. There are no mileage restrictions, and hire purchase can be used to finance older cars as well as new or nearly new cars. So let's look at an example. For hire purchase, you decide the length of the loan. There are no mileage limitations to agree. The lender then calculates the monthly payments, similar to the factors for PCP, but in this case the full value of the car is included in the monthly payments. At the end of the loan term, you own the car. Hire purchase may be suitable for those who wish to own the vehicle at the end of the finance period, or be able to use the full value of the vehicle as part exchange towards another car. If you plan to keep the car for a long period, such as 5 or more years. If you do not want mileage restrictions, and if you're buying a new car and can afford the higher repayments, or you're buying an older car where PCP is not available. Here we compare PCP and hire purchase side by side. So hire purchase is available for new, nearly new and used cars. PCP is only suitable if you'll replace your car every 2 to 4 years. Hire purchase is suitable for long and short-term car ownership. PCP has lower monthly payments, but higher overall interest cost. PCP protects from depreciation. Hire purchase does not have mileage limitations. If you'd like to know more, then get in touch with one of the team at Motor Pocket.